Hi everyone. So the purpose of this video is just to show you what the CTA summaries notebook and AI tutor is, a little bit about how it works and how you can use it to enhance your learning experience while you're preparing for your upcoming assessments or whatever the case may be. So this is more or less what it looks like. You can ask it questions and it will answer your questions based on my summaries, which I've uploaded onto this AI model. So just to go to show you in this tutorial, I'm going to take two exam papers. So these are my October 2023 CTA exam papers, and I'm just going to run through a few questions to show you how I would use it in a preparation stage, preparing for my upcoming assessment. So while I'm preparing for my upcoming assessment and working on my exam technique and, working on my knowledge to improve it, I read this question. So part 2A, or question 2, part A, the first question, critically review the revenue recognition accounting policy provided, note 3 of the summary of group accounting policies. Include positive and negative comments for your review with reasons for negative comments. Also include recommendations. So then if I go up to note 3, just to show you what that says. So you can see here it is about revenue recognition, sales of goods and related revenue, and then it's lay-by sales specifically. So if I go back to the AI tutor, and while I was reading that question, I just completely forgot how to recognize lay-by sales. Like, is it on day one? Is it at the end of the term? Like, when do I do it? Like, where do I even start to think about this? So you can actually go ahead and ask this AI or the tutor what the answer is. So I have the question copied here. I'm just gonna paste it, and I'm just gonna make this say, so how should lay-by sales be recognized in terms of IFRS 50? Let's ask it. See what it gives us. There we go. So it is quite a big piece of reply we have here. So it says, IFRS 15 does not specifically address lay-by sales. However, the core principle of IFRS 15 states that revenue should be recognized to depict the transfer of control of the proposed goods or services to the customer. That makes sense. It really does ring a bell. So there's no determine how lay-by sales should be recognized. You would consider when the control of the goods transfer to the customer. And then there are a few indicators of the control being transferred. And then in a typical lay-by sale, the customer does not acquire control of the goods until the final payment is made. Until then, the seller retains possession of the legal title of the goods. The seller also bears the risk and rewards of the ownership, such as the risk of damage or loss. And therefore, the revenue for lay-by sales should generally be recognized when the final payment is received and control of the goods transferred to the customer. And then it even gives us an example. So there is an example, and it would depict the solution to that. But while reading this, I remember Mr. Ahmed always said that we should answer any revenue question in terms of the 5 steps of revenue recognition. So I'm going to ask it, please, can you answer the above revenue question by referring to the 5 steps of revenue. Oh wow, my spelling recognition. Let's see. There we go. So we have step 1. Identify the contract with the customer. A lay-by agreement constitutes a contract as it represents an agreement between the seller and the customer for a future sale of goods. The contract outlines blah, blah. Then identify the performance obligation with the customer. In a lay-by sale, the seller has a single performance obligation to deliver the goods to the customer once the final payment is received. Determine the transaction price, allocate the transaction price to the performance obligation, and then the recognizing revenue when or as the performance obligation is satisfied. So you can see it really pulls everything as we've learned it, because it's pulling it from my summaries, which is more or less how I summarized it, as we were taught. And then this is the key step for lay-by sales, which is very true because that is the main question here is when do we recognize revenue? As discussed in a revenue recognized when the performance obligation is satisfied, meaning when the control of the goods transfer to the customer. So there it just goes over that principle again of control needs to transfer to the customer in order for us to recognize revenue. So another nice feature of this app or website, whatever you want to call it, is that it has references. So you can see here, it actually has like a little one here, a little one here. And what that is literally you can click on it and it'll take you to the source document where it found this information. So if I click on it, here it says source guide, and it will take me, highlight in purple, the exact part of the summaries where it found this piece of information. So here it is, core principle of IFRS 15. There it says that revenue is recognized to pick the transfer control of the promised good, which is also what we saw at the top there. And then it gives us the indicators of when the control is transferred, which is physical possession, legal title, and so on, which is exactly what it put in bullet point form here. So it really takes it to the next step, being able to actually reference and go to the source document. And, if you feel you're lacking some of the information, you don't have a full grasp of what the tutor is telling you, you can actually click on the resource and it will take you to it and you can read more on that. Okay, so then let's take a look at a second question. So let's take a tax question. Here it says, calculate supported with reasons, where necessary, the tax implications for PEPCO in respect of lay-by sales for the 2023 tax year and the tax periods falling within the 2023 tax year. So we know that when something says the tax implications, I hope you guys remember, but that includes all forms of tax, VAT, income tax, dividend withholding tax, any sort of tax you can think about is included in that scenario. So I'm just going to break it down a bit more simple for starter, just to start off. So I'm just going to make it VAT. I'm just going to ask it for the VAT treatment. So I've got a question copied here. So I'm just going to ask that. What will be the VAT implications of lay-by sales? Let's see what it tells us. All right, here we have it. So VAT implications of lay-by sales. The source provided limited information directly related to the VAT implications of lay-by sales. However, there are some insights into VAT principles that can be applied in the scenario. VAT is a consumption tax. Okay, so there we have that, time of supply and value of supply, which we know is very, very important whenever you address a VAT matter. So here it says the time of supply determines when a VAT liability arises. There are different rules for determining the time of supply for goods and services. For goods, the general rule is the time of supply is the earlier date of invoice, the date the invoice is issued and the payment is received. And then we have the value of supply. The value of supply, okay, I'm not going to read that whole thing. And then it says applying the VAT principles to lay-by sales. Given the principles, we can consider how they might apply to lay-by sales. So time of supply in a lay-by sale, the customer typically pays for the goods in installation before taking possession. The source suggests that the time of supply for goods is generally the earlier of the invoice date or payment date. This implies that for VAT purposes, each installment payment is in a lay-by sale could possibly trigger a VAT liability. So because we are taxed on the earlier of receipt or accrual, that would mean that would be with each payment. And then it says a customer enters, and then there's a small example. So this would be our example we have here. So that's just to help you to think about all the possibilities and to help you identify some triggers, to help you identify possible solutions, because obviously this won't be correct every single time. It will miss some important parts. It will miss some easy marks that you can score. So it will miss some of the basic, low-hanging fruits that you might have been taught in university, but this really does help you to just grasp a bit more of the question and grasp a bit more of the content. And while you're studying, and you really don't know even where to start, this might be a good place to just point you into the right direction, if that makes sense. So let's take the final tax question. I have it here. Assume the directors exercise their option and acquire shares in Wesco Limited. Briefly discuss the income tax implications for Wesco in respect of the shares issued to its directors. No calculations are necessary. So just to go up to the share part where they mention it. Yeah. So here's the share incentive scheme. And then it just gives us some background on the share incentive scheme. So I'm not going to read through that completely. I'm just going to ask it a question on this share incentive scheme. So I'm asking it, what are the income tax implications of share incentive schemes for the directors or employees who are entitled to the share? So I can't remember all the sections. I can't remember all the small nuances that are important for these type of transactions. So now I'm asking my tutor to just guide me into the right direction. And let's see what it gives us. So here it says, the income tax implications of share investment schemes, and then taxed upon vesting. The income tax implications for employees arise when the share options vest. That sounds quite familiar. This means that when the employee becomes unconditionally entitled to the shares, that's also quite a good trigger word. Then the taxable benefits is calculated as a difference between the market value of the shares on the vesting date, and the cost the employee paid to acquire those shares. And once again, it has some nice references, so you can actually click on that, and it will take you to your source. There we have it. Then restricted versus unrestricted options. The vesting date depends on whether share options are restricted or unrestricted. So unrestricted options vest on the date of acquisition, i.e. when they are exercised. And then restricted options vest on the earlier of, when all restrictions are lifted immediately before death or when the shares are sold. And then future CGT implications, the market value of the shares at the vesting date becomes the base cost of the future capital gains calculation if the employee later disposes of each shares. And it even gives us a nice example. And then there's an employer perspective, which is not even something I asked, but it also gives us that. So obviously we can stop reading from there on forward. But this is just to show you more or less what this AI tutor can do. So I think there's one more question I just want to run through before we end this off. Yeah. Okay, so this is question 1 of that 2023 October CTA exam, which reads, with respect to email 102, recoverable amount, discuss any concerns you have with the value in use calculation. Provide reasons to support your concerns and include a correct value in use calculation. So off the bat, the first thing that pops to mind is that I've never done a CGU, cash generating unit value in use calculation in financial accounting. Because yes, this is a financial accounting question that is in respect of a cash generating unit. So I don't even know where to start. How do I even start calculating this value? So the nice thing about this is, obviously, as you are studying and preparing for the assessment, you can ask your AI tutor this question, and you can actually save the response and revise it a few days before the exam. So let's say, how do I calculate the value in use, or value in use of a cash generating unit? Let's see what it tells us. All right, so to determine the value in use of a CGU, you would calculate the present value of all future cash inflows expected to be received by the CGU. It is crucial to use a pre-tax discount rate and a pre-tax cash flows. Okay, well, that's quite interesting. So obviously, whenever we have post or after-tax amounts, we need to convert that to pre-tax. Additionally, finance inflows and outflows should be excluded. So financing inflows and outflows would be interest earned and interest paid. So that would obviously be excluded. Then we have when estimating future cash flows, the CGU should be considered in its current condition. Future restructurings that the entity is not yet committed to, or future capital expenditure that will enhance the asset's performance should not be included. And if the goods produced by the CGU are transferred internally and not sold in the open market, the entity should use management best estimate of the market value of those goods. So there we have quite a good summary of just what to include, what rate to use, what not to include. and it does pretty much point us into the right direction. If we want any additional questions on this, maybe what do I include in the present in the future cash inflows? What are all the items that I should include in that? We can ask it that as well. So there are follow-up questions that you can ask to gain even a bit more insight. Or if you want to know what a pre-tax discount rate is, you can probably also ask it that. I haven't tried it, but I mean, you can go into any one of these bullet points and ask it to explain a bit more of that and go into more detail. Um, so yeah, that's about it. Just to show you how this works and what you can do with it. All four your core modules have been loaded onto this notebook. So you are able to ask it any questions in respect of auditing, financial accounting, management accounting, and costing and taxation. And yeah, I hope this is beneficial to whoever sees this and that you guys enjoy making use of modern technology and the advances that we have.